All right, so I had just posted videos on what banking is. It's a financial intermediary, what the fractional reserve banking system is, how it works, money, how it functions in a society, the definition of the supply of money. So these are all already posted. So now I want to go over the money multiplier. So and in a subsequent video, I'm going to go over the accounting wise how banks create money. All right. So the money multiplier is a lot like the GDP multiplier. If you remember, and you want to go back to a previous video, the GDP multiplier, according to Keynes, was someone spends money, creates GDP, someone spends $1 on a burger, McDonald's goes, and if the MPC is 0.9, McDonald's spends 90% of that dollar, and a beef supplier, the beef supplier takes that 90 cents, spends 90% of that, and so on and so forth. So that $1 will create 1 over the MPS, or in this case 10. That $1 will create $10 of GDP. It's a lot like that, but in this case, it's how banks create money. So instead of GDP and GDP creation, this is money creation. All right. So when we go over a bank and how a bank creates money, you have to understand, again, in the previous video, how a bank works. So what that bank will do is that bank will take, let's say, Mr. Krause, let's say I wasn't a teacher and I actually had money. Mr. Krause has $1,000. Okay. Now, there's two things that the bank does with this money. First of all, in the previous video on tools of the Fed, I told you about a reserve requirement. Reserve requirement is what the banks are required by law to keep. Okay. So when the bank, so let's say the reserve requirement is 10%, which it is in the United States today. All right. So if the reserve requirement is 10%, if you do 1,000 times 10, so that means the required reserves, 1,000 times 10 is $100. The banks must keep by law $100 of that 1,000. Now, the remainder is what's called excess reserves. All right, excess reserves. So out of that 1,000, 100 is required reserves, 900 of that will be excess reserves. Okay, what can banks do with the excess reserves? They can loan out those excess reserves. Okay, so those excess reserves become loans for that bank. All right, and hence that's when the multiplier, that's when the money multiplier starts to happen. So if we go into Mr. Krause's deposit and we do that, let's on the AP test, they could say, all right, Mr. Krause deposits $1,000. How much is the total money supply changing by? How much new money is there? All right. And to go back to this on your notes, make a mental note. If an individual deposits money, that $1,000, I got that from somewhere. That was already part of M1. That was already part of the money supply. All right. I assume it's either cash in my pocket and I'm depositing it into my account. All right. If the Fed has money and the Fed buys $1,000 worth of bonds from that bank or securities, then Fed money is not money until they release it to the public, until they deposit it in that bank, until they buy that bond and they give the bank money back from that bond. So Fed money is brand new money. That's brand new M1. Once they buy that bond, that bank is sitting with brand new money that never existed before. Okay? Whereas Mr. Krause's money existed before. It came from my pocket. That's an important distinction on the AP test. They will go back and forth to that, and I'll show you how that works. All right, so let's do the Mr. Krause example and show you how much money that creates. So first of all, they have to give you this. They have to say the reserve requirement, and they have to say something like the reserve requirement is 10%. Okay, so Mr. Krause deposits, I said, $1,000 in whatever savings bank. It doesn't matter. So $1,000 and the money multiplier, okay, on your notes, the money multiplier is whatever the reserve requirement is. It's 1 over the reserve requirement. Just like the Keynes GDP multiplier was 1 over MPS, well, in this case, it's how much money is created, and it's 1 over the reserve requirement. You need that because over here, as you can see, the money multiplier was 10%. So Mr. Krause has $1,000. I take it from my pocket. I deposit it into my checking account. All right. The money multiplier, I multiply that 1,000 by the money multiplier, and I get the total money supply change. All right. So I like to break it down step by step with math. $1,000 times, we said the reserve requirement was 10%, so 1 over 0.1 equals $1,000 times 1 over 0.1 is 10 equals $10,000. Now, this goes back to that other point. Of that 10,000, that includes that 1,000 that I deposited. So what I have to do, if I want to find out the new money created by that, I have to back out that 1,000 because that was already part of the money supply, so it won't reflect new money. So 1,000 minus 10,000 minus 1,000 is $9,000 in new money. New money. Okay. Another way of doing that, so that's one way. You take the total deposit, you multiply it by the money multiplier, and then you back out the original deposit. Another way to do that, if you have an individual depositing money, is to go back to the required and excess reserves. Of that $1,000, all right, the reserve requirement I said was 10%. Of that $1,000, if the reserve requirement is 10%, the required reserves that the bank has to keep by law is 100. The excess reserves is 900. That's how much they can loan out. That gets into the other way of doing it. You can, in your head, say, all right, the new loans will be $900. The excess reserves is 900. I multiply that by the money multiplier, which is 1 over the reserve requirement. And I get new money. So in this case, 900 times, we said it's 1 over 0.1. 900 times 10 equals 9,000 new money. All right. So whether you do it this way, multiply it by the excess reserves or the loans, that will give you the new money, or you multiply it by the original deposit and then back out the original deposit. It doesn't matter. You still get the same answer, $9,000 in new money. Now, compare, let's say the Fed, all right, one thing you do have to know, which goes back to my tools of the Fed, in monetary policy, remember bullshh, BLLSHH. So if the Fed buys bonds, buys bonds, Fed buys $1,000 worth of bonds. You have to understand what they're trying to do with that. The Fed is taking a bond away from the bank, and the bank's not going to give that away for free because that's a valuable asset. So the Fed has to pay them for it. So the Fed pays them $1,000 in cash. The bank doesn't care whether it makes 5% on the bond or 5% on a prospective loan. They're just there to make money. All right. So when the Fed buys that asset from the bank, what the bank is now sitting with is, because they had that bond and that bond got taken away and it got replaced by cash from the Fed. That's brand new cash that they can loan out, first of all. Second of all, because that money was just brand new money released by the Fed, Fed money is not money. It's not part of the M1 money supply until they release it to the public. Well, that's what they just did. They bought that bond from the bank and they gave that bank $1,000 that they can now loan out. So that $1,000 is new money. That's important when we get into on the test, they might make a distinction. If the Fed buys $1,000 versus someone deposits $1,000, where will more new money be created? And the answer is always the Fed. All right. So if the Fed buys $1,000 worth of bonds, then the banks are sitting with $1,000 in excess reserves. Okay, they can loan that out. I multiply that by the money multiplier, which is 1 over the reserve requirement. So $1,000 times 1, and that gives me new money. So $1,000 times, we said in this problem, the reserve requirement was 10%. So $1,000 times 1 over 0.1 equals $10,000. Okay. That 10,000 in the Fed problem is all new money. So notice how if we go back to here, if it goes back, when an individual deposits money, Mr. Krause deposits $1,000, it only creates 9,000 in new money. Whereas the original Fed deposit is new money, and then everything that it creates is new money as well. All right. So that's the big distinction, is when an individual deposits that money is already part of the money supply. Whereas when the Fed gives the bank money and buys bonds, that's new money, and anything that creates is new money. So to do one more practice problem, all right, and I'll send you guys, my people, I'll send you. There's in 2009 and 2012, there are practice problems that you can look up. All right, so let's say they might do something like suppose they go to a 25% reserve requirement. And suppose now Mr. Krause, right, I got upgraded. Now I'm depositing $10,000. All right. And suppose the Fed buys $10,000 worth of bonds. By the way, hopefully you could reverse this. The Fed, they could say the Fed sells bonds. Well, in that case, they're trying to reduce the money supply, and you would just reverse all this. Okay. So in this case, let's do Mr. Krause deposits $10,000. All right, I'll do it the second way. Of that 10,000, they're required to keep 25%. So in this case, 2,500, right? Excess reserves is 7,500. Okay. And now so I do 7,500 times my money multiplier, which is 1 over 0.25. All right. So 7,500 times 4. Okay. So 7,500 times 4 is 30,000. That's new money. The other way to do that when an individual deposits money is you can say Mr. Krause deposits $10,000. The money multiplier is 4. 10,000 times 4 is 40,000. But that 10,000 was already part of the money supply, so that 40,000 is total money. I subtract out the part that was already part of the money supply, and I get 30,000 new money. Now let's go back to the Fed. If the Fed buys $10,000 worth of bonds, and it's in a 25% reserve requirement instance, 10,000, the Fed buys bonds, that's new money released by the Fed, times my money multiplier, which is 1 over 0.25, equals my new money. So 10,000 times 4 equals 40,000. So those are just two examples of when the Fed deposits money versus when an individual deposits money. Now, which money multipliers are they going to use? Well, on the test, they're going to use the ones, just like the GDP multiplier, they're going to be using the ones that you can do in your head, because prior there was no calculator allowed before this year. So 10% all right, because 1 over 0.1 is 10. So this is, I'll put reserve requirement, and this is the multiplier. So if it's a 10% reserve requirement, 1 over 0.1 is 10, because that's a tenth. If it's 20%, that's a fifth. 1 over 0.2 is 5. If it's, 25%, that's a quarter. 1 over 0.25 is 4. If it's 33%, give or take, that's a third. So 1 over 0.33 is 3. And if it's a 50% reserve requirement, then the money multiplier would be 2. So notice when in our tools of the Fed, if they lower the reserve requirement, if the reserve requirement, let's say, goes from 50% all the way to 10%, so the Fed decides to lower the money multiplier, the reserve requirement. Notice how the money multiplier gets exponentially bigger, right? So you have the money multiplier, when they have to keep half of all that money, the money multiplier is only 2. They can only create so much money. Whereas if they're only required to keep 10% of that, if the reserve requirement is 10%, they can loan out 90%, they can create a lot more money. All right, so that's why it's expansionary. You can create money, and if you create money, you lower the interest rate because money is less scarce. And if you lower the interest rate, everyone starts spending money. So that's the tools of the Fed. That's the money multiplier. That's how it works. That's how you'll see it on the test. So take a look at that. That's a tough concept, but study it. All right. And we'll come at you. Next video will be the accounting of how banks create money.